Well, good afternoon, everyone. Welcome to season 6, episode 5 of our podcast. Today is June 24th, 2025. We're going to cover several things today. We just had a Fed decision. I'm going to cover that and what's the outlook. And then I'm going to do a pretty detailed update about where we stand today as far as the tax bill. And then, we've had a little war going on here between, just a little one, between US and Iran and Israel. And Dryden is going to cover, he has a lot of experience in that, being a retired colonel. And then we'll talk about earnings outlook and why the market did very well today. And then cover some important dates to watch out for. So without any further ado, I'm going to go ahead and ask Dryden our very first question, which is really on top of everyone's mind. Not the war. I'm going to start out with interest rates. We had a Fed meeting last Wednesday. Normally we have a meeting on Thursday right after, but we did it today on Tuesday. Actually, it was good because he actually spoke today. Powell spoke for a long time today and gave us even more insights of what he's doing and why he's doing what he's doing, because he did keep interest rate the same, even though there was a big push to reduce rates. But there's a lot of reason why he's doing that. But most of all, what we want to know why he did it and what can we expect for the rest of the year, Dryden.
Sure. I think, the question that everyone's always been having is like, when do we get a rate cut? So how big, when do we get it? How many do we get? And what's the size? I think everybody can pretty well circle up around the point that the size is going to be a quarter point. Now, the question is when and how many? And the Fed has been very, very careful, and rightly so, not to be premature in cutting interest rates, even though they get a lot of pressure to do so externally, because they're worried about reigniting inflation. And now, the other concern that was brought up is we don't know what the pass-through of the tariffs are. So the question is, we had a very strong economy. It's moving from a torrid pace down to a sustainable pace. We're seeing some leveling out on core inflation. That makes good sense. But the question is, what's next? And so there's uncertainty around whether or not the tariffs are going to be fully passed through. And if they are, is that inflationary? Let me help break this down just for a second.
Okay.
Tariffs don't necessarily pass through 100%. As a matter of fact, there's three parties that pay for tariffs. The country of origin pays for it, the exporter pays for it, and the importer pays for it. In other words, and the question is how much of it gets passed through to the end customer. And if you try to say we're passing all of it through, then obviously that becomes inflationary, but that's not really the case. Governments in and of themselves have a way of supporting this with what we call TIC. They have tax policy where they can give lower tax rates. We do that in the United States for exporters. There's lower tax rates on profits from exporting. They have interest rate adjustments that they can make. We have an export-import bank. So do other countries. And then they have currency adjustments that they can make. We don't mess with our currency very much, but rightly so. You can take a look at the circumstances for China when they first announced the tariffs. What did they do? They allowed their currency to become devalued. So the country of origin pays part of the tariffs. Then the exporter ends up paying part of the tariffs because they have to adjust their prices, because if they keep their prices too high, they don't sell enough, right? So they're not able to sell. And then the importer takes their part that they have to do, because in the end, you have to keep the prices where the market clears and the customers continue to buy it. So it's uncertain now exactly what the levels of tariffs are. All the deals aren't done yet. We don't know if we're at 10 or we're at 20 or whatever that is. And it's going to be a while before that straightens out. And then we don't know how much of that gets passed through. So the Fed's sitting there going, we don't have to do anything right now. And why do we have to do something in an uncertain environment? So what you can probably expect is you may get one cut in July, maybe after July, and then maybe a pause. And they can kind of see how this all works out. So we're in the camp that you might get one or two this year. Some people are predicting three, some in the market are predicting three, but we actually are more focused on it. It's more like two. But I think the important thing to recognize is that the next move is certainly down. and the next move will certainly come sometime between now and the end of the year. And it will be seen as stimulus to the economy and probably stimulus to the markets.
Okay, well, that is consistent to quite a bit what Powell said today. And because, the areas that are really hurting is the housing in area. And so they do need to reduce rates and we agreed that there'll be 2 to 3 before you end.
Two to three cuts, not 2 to 3%. No,
No, 2 or
you're not
3.
going to see 2 to
No,
3%
2 or 3 before
anytime
you end.
soon. No,
2 to 3 times before you end.
You probably you're going to see quarter point cuts, and that will be stimulative to the market. But they're going to wait and see. The Fed has done a good job of bringing inflation under control and maintaining some stable price stability here. And they're going to be cautious, and that's probably, at least in our view, makes pretty good sense.
All right, so the next big thing everyone is interested in is what's going on with the tax bill. As you know, the House passed the bill last month, and now it's in the hand of the Senate. The Senate has made quite a bit of changes from the House. So I'm going to try and remind you a little bit of what we think is still in this bill that the House passed, and some of the changes that the Senate is working on. One of the big changes is the House had increased the child tax credit from 2,000 to 2,500. The Senate wants to only increase it to 2,200, but actually make it permanent. So that would be an increase, but not as much. Also, they're talking about increasing the standard deduction to 32,000 for married filing jointly and 16,000 for singles. But the big thing I know that really many of you are interested in is the senior deduction, which they can't call it Social Security because it actually applies to everyone over age 65. So even if you're not getting Social Security, you will get this deduction. And the House passed it at $4,000. The Senate is actually raising it to $6,000. However, it does phase out if you're a single taxpayer and you make more than 75,000, it starts phasing out. And for a joint, once you make 150,000, then that deduction will phase out. But for many retirees over age 65, if they're jointly and they're making 150,000 and they have Social Security income, $6,000 of their income will be non-taxable, which is be a very good thing. Also, the estate tax and gift tax exemption right now is almost 14 million per individual, 28 million for couple. They're talking about raising that to 15,000 for single and 30,000 for married couple, but most of all making it permanent, which we don't have to worry every so many years as the exemption can go back up, because it really makes for horrible planning when you don't know if these limits are going to change. So making it permanent and actually indexing it for inflation will allow many estates not to be taxed, which is huge to many of you listening and many of you who are our clients. And then let's see, one very big thing I thought I really like in the Senate bill, the House allows you to, if you don't itemize right now, then you're doing any giving to charities, you don't get a deduction for it. So the House put in $300 above the line, which whether you itemize or not, you can deduct, which is not very much for a couple. The Senate is raising that to 2,000. So now, which is a big push by the charitable organization to allow people above the line. So whether you itemize or not, you're able to deduct if you give to any charities as a couple 2,000, single taxpayers 1,000, you'll be able to deduct that whether you itemize or not. So I'd love to see that pass. This is a big change from the House to the Senate. And then they had very complicated rules as far as the tax on tips and tax on overtime. What they're doing is they're allowing a person to make as much as 25,000 in tips or 25,000 overtime and not have that taxable, but it does phase out if your income is, I believe, and of course, all these numbers are still going to change, but incomes over a 300,000 AGI, then it will get phased out. there. They are going to allow interest on car loans, but the House allowed it on used and new cars. The Senate only wants to allow the interest expense on cars made in America of $10,000 or more, but only on new cars, and only once your income is above 200,000, that gets phased out. Let's see, 529 plan, big changes there, allowing that money to be used for elementary and secondary schools, also allowing it for books, tutoring, and additional classes outside the home, and test fees. So that would be a very welcome use of 529 plan. We think it's a great thing to fund for children and grandchildren. And EV tax credits, the House was going to phase those out by year end. EV and solar, the Senate is allowing up to 2 years to phase out, so a little longer.
So you covered very well a lot of the things that as it pertains to individuals, but also in this bill, there's certain corporate activities that go on, and that obviously is going to affect earnings and how it's going to affect stock prices. Can you go ahead, if we've talked about how it's going to affect individuals, but can you talk a little bit about what happens in the corporate tax components of this? Because that's one thing we were going to pay attention to because it all affects earnings.
The big thing that they're allowing is business expensing. They right now they really want to encourage business to obviously invest in the United States, and the current rules were already phased out. Now the House restores full expensing for R&D and capital investment. The Senate has similar revisions, but there is some phase out implementations. But one of the big things that applies to most small businesses is the qualified business income deduction. They will allow you, right now you can deduct 20% of your income as a deduction. That will go up to 23%, which is huge. They still exclude financial services and doctors and lawyers, but most manufacturing firm, huge increase from 20 to 23%. But one that really applies to many small businesses is the 1099. Right now, if you have any person that you give $600 or more, you have to send them a 1099. They want to increase that to 20,000. So make it a little less cumbersome for businesses to actually hire individuals without that. And they're also doing some work as far as the gig industry, the Ubers and so forth. Those people are going to still be self-employed as opposed to employees.
Yeah, there's certainly been a move on in the previous administration to try to bring everybody into some sort of W-2 fully taxable thing to obviously increase tax revenues and regulatory oversight. But the key thing here is when you think of the nature of work has changed for many people. Not everybody, but many people have a side hustle, or many people have something that they're doing other than their normal regular job, or they have multiple jobs with multiple companies. And therefore, this cumbersome activity is limited through these corporate tax moves. So more to come on that. And I think, as we said, this is a bill, not a law. It hasn't passed yet. These are the things that are proposed, not necessarily approved and signed into law. There is a strong bias towards getting a tax law signed by July 4th. And the great big beautiful bill signed on July 4th. There's a good likelihood that could happen. There's a desire to make it happen. And if not, it maybe gets pushed a little bit. But it's that push and pull between the taxes that come from the tariffs and the tax cuts that are embedded in the tax bill, that we try to bring those things together so that you have a net stimulative effect on the economy. So everyone's waking up and doing new math every day. And we'll be watching this carefully, and Layla will be walking you through it as these things become revealed.
I have to tell you about the Trump account. I got to tell you about the Trump account for children.
Go right ahead.
Okay, so any child under age 8, okay, the government is going to give them $1,000. Okay, and then anyone, businesses or parents and so forth, they can put in as much as $5,000 into this, and they can do this between now, 0 and age 8. They can't take any, they can't make any contribution past 8, post age 18, and no distribution before age 18. But once they get to 18 to 25, they can take 50% of that. They can use it for higher education, business loans, or first home purchases. At age 25, any amount um, they can use a bit more for the above purposes. And at age 30, they can take the money out for any purpose. And that money grows tax deferred. It's just allowing children to have kind of a 401k.
It's allowing, I mean, when we think about this, and as we have many families, many multi-generational clients, it's a way of giving children a head start
Grandchildren.
and grandchildren a head start on growth and capital. And we all know the power of compounding. And so being able to have families be able to go in together and support a child early allows that to compound all the way through their life and give people a head start. And this is, you're seeing this today when one of the challenges that people have in the housing market is it's very hard for someone to accumulate the down payment, depending on where they live. And so people are having to defer housing purchases until they can accumulate that or making decisions. We actually did an article coming out in Forbes on that. But the point being is that this particular component of the bill, the Trump account, allows an individual to have capital formation at a much younger age than before, and more people make contributions to that, and it to move forward in a tax deferred.
I think that's great.
It's a great idea.
Right.
It's a great idea.
So now let's talk about the war of the day. No. We've had quite a bit of war news here between Israel and Iran, and of course the US bombing. And you would think that when you woke up Monday morning after the bombing on Saturday, that the market would be way down and that, things would be horrible. And you looked and the market was a little bit down. By the end of the day, the market was up. And then today, market was way up. And that's just the opposite. I had quite a few worried clients that, oil was going to go to 100 and the world was coming to an end, that we're going to have retaliations and all that. What happened, Dryden?
Sure.
You're the expert at this.
Well, I think part of it is we're going to unpack this in multiple ways. What you've seen happen in the last 72 hours or 4 or 5 days anyway is a removal of a certain amount of uncertainty that had been existing for a long period of time. Everyone was worrying about when was the event going to happen. When most people thought it was inevitable that we were going to have to attack the nuclear facilities and try to take them out. And so the question was when? And then what's going to be the response? And would it be successful? And all of those debates. So, there's more panic about something sometimes before it's going to happen than when it does. So the uncertainty around whether or not we would ever do it, that's gone. We did it. Then the uncertainty about whether we would have casualties in the process, we didn't. Then the uncertainty around whether or not there would be a nuclear fallout, there wasn't. Whether or not we would get it all, that's still a little up for debate, they're saying, but it seems to be the battle damage assessments are quite catastrophic to the long-term program that Iran had. So you had all of these things occur. And then you had the question is, well, what's the next order of effect? What's going to be the retaliation? And the retaliation was measured for very good reasons, and I'll unpack that for you. We dropped 14 bombs on them; they shot 14 missiles back, and we knew they were coming. They identified that. They let Qatar know. They let us know. But Iran had to do something. They couldn't just not. And they did this before. They did this. They did this when the last 100 missile barrage went forward. And so when they have to do something, they do it. And they say we have to do this to play this tit for tat, save face, and things like that. So they had a measured response. The reason why they had a measured response was the least that they could do was they did not want to take a risk of engaging or having an American soldier die or American populace die or something like that, where there was a direct attack on the United States of America. We attacked their nuclear facility, not necessarily them as individuals and not their leadership. Although we probably had the capability to do that. We attacked the facility, and the facility was the thing we've said for years they could not have. The ability to have a nuclear weapon, they could not have. And so we did that. They, in response, attacked the least that they could do to save face in this. And so that helped remove the risk of an immediate catastrophic return. And I think that people are learning that Iran's ability to carry out military operations is somewhat limited. Pretty good at terror, not that good at war. And the issue is I can go on that one for hours. But as we look at that, that didn't happen. Now the big thing,
Oil.
The big thing is oil. So why did the market react in effect favorably after all this? You've removed some of these uncertainty risk. It happened. Okay, so that's done. But now what was going to happen to oil? Oil did not spike to $120 a barrel. Oil did not spike to $100 a barrel. In fact, if Iran came offline completely for one reason or the other, it's about 4 million barrels a day. Easily the rest of OPEC could make up for that. There's excess capacity for that. So in a global price, Iran being out of production is a non-event. Now let's go to the Straits of Hormuz. 20% of the world's oil rolls through there. For the United States, it's almost a non-event. Very little of our oil, less than 2% of our oil comes through the Straits of Hormuz. So we get our oil mostly from Mexico and Canada. We don't get that much of it from there. We have other ways of getting it. So to the United States, in and of itself, our oil supply is pretty well unaffected. Now, China is massively affected. South Korea is massively affected. Europe is massively affected. India is massively affected. All those other countries who sometimes are our allies and sometimes not, right, are massively affected by the closure of the Strait of Hormuz. And they would be very, very happy for the U.S. Fifth Fleet out of Bahrain to clear the Straits of Hormuz. Now, ladies and gentlemen, I got to share this with you. The Fifth Fleet can do that. They've had 40 years to rehearse it. We had 10 years to rehearse the four-door attack. That went off flawlessly. They've been practicing the attack on the nuclear sites for a long time. There's a bunch of plans that are well set for clearing the Straits of Hormuz. This thing, even if they tried to mine it, even if they did all that, it's over in a matter of days. And Iran does not want to be in a military confrontation directly with the United States because they've already lost their ability to secure their skies with air defense artillery. So I think all of these things come together to say all the things that everybody was scared of.
Uncertainty.
And all this uncertainty has been relieved. And this is a relief rally. Now, in addition to the relief rally, there's some other things.
And those are really exciting. So, you wake up today and we have a really good market today. And one of the reasons the market is up today, it's not just because the relief or the ceasefire from all these things Dryden just talked about, but for the very first time this year, we've actually had earnings increases, estimates increases. And so, and in the companies, the technology companies that we like, and the areas that there's a lot of spending, there's estimates increases. You want to comment more about that?
Sure. Well, the thing is everybody was again talking about the uncertainty with everybody talked down the earnings first quarter. They didn't know about the tariffs. They didn't know about this. They didn't know how it was going to affect things. But the fact of the matter is that the capital expenditure, the CapEx of all the big companies in first quarter nobody pulled back. Everybody's going full speed ahead. Let's build out the capitalization of artificial intelligence. Let's build the infrastructure that we need for the waves of the future. So nobody cut back on cap spending. Well, if they don't cut back on cap spending, you're not going to see a reduction in earnings in the following quarter, right? And so this is what happened. So everybody who had talked down their earnings because they were worried about whether it's tariffs or lower CapEx spending found out that they had really three things happen. The tariffs have not had that big of an effect. The CapEx spending has not changed. And then if you remember, from last year to this year, interest rates are a full percent lower. So their cost of capital for inventories and things like that, their carry costs have gone down by 20%. All of those things expand profit margins. All of those things expand earnings. And so what you're seeing is this earnings expansion, thus it turns into earnings surprises, and you're seeing tech earnings increasing, and people going, oh, wait a minute, this engine of the S&P 500. I mean, tech earnings are now with 25% of the S&P 500 earnings, and now you're seeing this continue to go forward. So as these revelations continue, we're going to see additional earnings growth, just because all of the bad things that people were talking about were going to happen didn't.
That's really good news, Dryden. And of course, the Fed looks at data to determine their views on interest rates. And one big one coming up is PCE on June 27th. We have CPI on July 15th. And of course, we have a Fed meeting on July 30th, which then we will know a bit more about what they're going to do. So consequently, we have our next podcast is also on a Tuesday, and it's on August 5th. Seems like people are really liking Tuesday. We usually like to do them on Thursdays after the Fed meeting, but we may change those dates to some of them on Tuesday, some of them on Thursday, but the next one is definitely August 5th, Tuesday at 3:00. We'll have our next podcast, which by then we should have hopefully a much more, we talked about the tax bill, but it's still all, proposals. Nothing is permanent. Hopefully we'll have a lot more permanent things we can talk to you about. And also we'll have the July Fed meeting, which will tell us the outlook of interest rates for that month and for the rest of the year. And then based on that, Dryden, where do we stand on the markets?
Well, again, at the next meeting, it'll be interesting because you will have removed the uncertainty probably by that time of what's exactly in the tax bill. It'll pass from bill
Maybe
to law.
Tariffs.
You'll know, you'll probably have several countries that we've finalized our tariffs with, kind of like we moved forward with Britain, but you'll probably have some much more clarity there. So all of those things, you got to make sure you tune in for the next time, because there's going to be a lot of uncertainty, just like uncertainty has made the market react positively now over this war. You're going to have a lot of other uncertainty have come out of the circumstance by the time we get to our next meeting. And we'll also know whether the first Fed cut is in July or whether it's pushed further
Whether
out.
the ceasefire actually sticks,
and whether the ceasefire holds, and there'll be violations of that. There always are. But I think the key issue is where we go from here throughout the rest of the year. We have been consistent throughout the year, even when there was this huge drawdown, that we felt that we would be up high single digits by the end of the year. We stand by that. We think that it's going to be a high single digit, low double digit market for the S&P 500. That could get revised upwards in terms of a little bit more on the where do we stand, whether we're at 9 or 10, 11 or 12, where we think the market is, based on earnings and based on how quickly some of these things happen and the final stimulative nature and the math around tariffs and tax cuts. But we still maintain, and if you saw us last month when things were crazy and the month before when things were a little ugly, we have maintained all the way through that we were in a positive market for the year, that we would end the year somewhere, high singles, low doubles. And certainly we have bounced all the way back, ready to hit new all-time highs on the NASDAQ 100 hit an all-time high today. So ladies and gentlemen, we're watching this very carefully. We pay attention not to the hyperbole or the headlines, but we pay attention to the bottom lines, because the bottom lines are where your earnings are, and earnings are where the valuation of your portfolios are. And that's what we're going to focus on. And we think that fundamentally, well, we're still in a very good position going forward. You can watch the news every day for entertainment value or panic value or whatever value you want. But what we're going to do here is what we do. And rather than get all wound up about headlines, we're going to focus on bottom lines.
And with that,
And bottom lines, pretty good.
Yep. And with that, we want to wish you a happy 4th. Happy Independence Day to all. And we'll talk to you on August 5th. Thank you so much.
Layla Pence is a registered representative with, and securities and advisory services offered through LPL Financial, a registered investment advisor, member FINRA/SIPC. Dryden Pence is a registered representative with, and securities and advisory services offered through LPL Financial, a registered investment advisor, member FINRA/SIPC. The financial professionals affiliated with PWM are registered representatives with and securities and investment advisory services offered through LPL Financial, a registered investment advisor, member FINRA/SIPC. Pence Wealth Management PWM and LPL Financial are separate entities.